Thank you very much. And first of all, I want to thank the organization, Santiago Castro, the president of ASO Bangaria, and Jonathan Malagon for inviting me and Anneke to this beautiful place, Cartagena. We have been here 20 years ago in Bogota and other places, and I'm really surprised. This is what economists call a positive surprise shock. I'm surprised by the development of the country in the last 20 years. And of course, you don't observe that because you are in the middle. But if you take 2 points in time, and 20 years ago and now, it's remarkable what kind of development Colombia has gone through. So that's first of all what I want to say. And I want to also thank the team of Santiago and Jonathan for the great support in helping me with all the data and all the other things. Without them, I wouldn't be here doing this presentation. Thank you. Okay, so first of all, I want to start with graphs, but before I give you the graphs, I can give you one. These are balance sheets. I will present a balance sheet of the Federal Reserve System, of the Bank of Japan, the ECB, and a little bit of the Bank of England, but that's not so interesting because of the methodological change in the construction of the balance sheet from the asset side. So let me first start with how should we look to this? And then you have to have a simple framework. And the simple framework is that after every financial crisis, there is always a period of financial repression, as we call that. And what is financial repression? Financial repression is the privileged access of the government to the capital market, to put it officially. And after every financial crisis, there is always financial repression, which is reflected in the negative real interest rates and sometimes even in the negative nominal interest rates, like we see now today in Germany, France, and most of all in Japan. I will show you that at the end. But the interesting thing is, why does that happen? Why does that happen? And why is monetary policy so unconventional that it's almost becoming fiscal policy with monetary instruments? That's an important question. And that question has to do with the fact that there are 3 possibilities to reduce your deficit to GDP ratio and, of course, your debt to GDP ratio. All countries are faced with this problem, developed and developing countries. And, of course, there are 3 solutions. I will start with the first best solution. The first best solution is structural reforms. Structural reforms in the product markets, in the labor markets, or tax reforms, like Colombia is now in the process of discussing that. And Robert Barrow will talk about that later in the afternoon. And these reforms are the first best solution. And why are they the first best solution? Because they have a numerator and a denominator effect. So, first of all, you reduce government spending, you increase taxation in a natural way, but you also increase growth, which is quite important, because growth is important to get out of the deficit and out of debt. So structural reforms are always the first best solution, although from a political perspective, it's difficult. Because for structural reforms, you need a long horizon. Now, you know, of course, that that's difficult in every country, developed or not developed. And sometimes I have the feeling, we are close to the Caribbean here, that we are confronted with a kind of Bermuda Triangle. Let me explain. A Bermuda Triangle of shortism. First of all, you have politics, which becomes with a shorter horizon. Then you have the media, who amplify all kinds of short statements, scoring behavior by politicians. And then you have the voters, who become very nervous, and there are swings in the polls, which influence the politicians again. So there's a kind of triangle where you get a shorter horizon. And all countries, all developed countries, developing countries, including my own country, the Netherlands, are confronted with that. And it's very hard to get out of the trap. So that's the reason why structural reforms, which are the first best solution, are not always implementable, are not realistic. The second best solution has to do with reducing government expenditure and raising taxes. That's easier. That's easier. It's not good for growth, especially raising taxes is not good for growth at all. It makes it harder for growth to continue at a certain pace. But because it's only a nominator effect and no denominator effect, it's really not the first best you want. And then there's a third solution, and that's the easiest solution. And that's the solution of what I call financial repression, which we face after every financial crisis. And that has to do with the fact that you go to negative real interest rates or even negative nominal interest rates. And that's a kind of redistribution between savers and debtors. And the savers are mostly in the private sector, of course, and the debtors are, well, mostly in the public sector. So it's a kind of redistribution. It's a kind of wealth tax, which is sometimes unobservable for the public, but which is already, since the crisis, since the Lehman moment, 2008, already there. So that's quite important way of getting out of the crisis and reducing your debt to GDP ratio and your deficit to GDP ratio. And then, in that perspective, you get privileged access of the government to the capital market, which is helped by, I would say, unconventional monetary policy. Central banks are doing things which are not normal. Today, this morning, President Mario Draghi of the European Central Bank announced that the ECB will also enter now the phase of buying corporate bonds. He said of high quality, of course, it's always high quality, but he didn't want to elaborate on which bonds. So we are now in a new process of unconventional monetary policy. So let me go to the slides. And this is the balance sheet of the Fed. Now what you see there is of course, two things. One is the enormous amount of government bonds and bills, US government bonds and bills, at the balance sheet. It's now stabilizing, and now the Fed is in the process of tapering, of building, the redressing the government bonds from the past. And you see that although the Fed is in the comfortable position that there is some growth in the US, not enormous amount of growth, it's very difficult for the US Fed to do that. And why is that so important? Why is that so difficult? We had the Bernanke moment 3 years ago. You know, of course, that Ben Bernanke announced to redress unconventional monetary policy that had enormous effect, not only on the financial markets in developed countries, but especially in the developing countries. And yes, I will go, continue. At 12 minutes or not? Okay, good, okay. So there I go to the second slide. That's the Bank of Japan. The Bank of Japan is doing exceptional things. My colleague Paul Krugman always says that his policies were never implemented. That's not true. This is the great Krugman experiment. And we know that that gives enormous problems. So, to my perspective, I think what the Bank of Japan is doing is so exceptional that I would say that that's very hard to see an exit. I don't see any exit at all. Then let me turn to the balance sheet of the European Central Bank. This is a balance sheet where you see the LTROs. The LTROs are long-term refinancing operations. That's not buying government bonds, of course. This is a long-term instrument for credit facilities. And the reason why it's so important in the ECB is by the ECB in the Eurozone is that the credit channel is much more important in the Eurozone than, for example, in the US. In the US, the interest rate, the direct financing, is much more important. So you see that, of course, the ECB is now entering the phase of buying government bonds of not high quality. We speak about the peripheral countries, and now entering gradually the phase of buying corporate bonds. And that's already since 1 year, and maybe I can elaborate on this. This is a forecast. So try to imagine, you see there the division between the LTROs, the 3-year LTROs, the LTROs with smaller maturities than 3 years, and of course the TLTROs. And now what Draghi announced, that's our TLTRO part 2, buying the government bonds. Now you see that that is quite stable, though the LTROs, which are divided in 3 categories, that's quite stable. But what is not stable is, of course, the buying of the securities. Asset purchases are rocketing. We have, at this moment, we have 3 trillion government debt securities at the balance sheet of the ECB, and that will rise maybe to 4 trillion, maybe more. Can you imagine what that means? You are bankers, so suppose that you would raise the interest rates. What that will mean for the balance sheet and the worth, the value of the securities at the ECB balance. It will be very hard, if not impossible, for the ECB to exit. This is really an enormous problem. And of course, not so difficult as in the case of Japan. But the problem with this kind of unconventional monetary policy, that the combination of these asset purchases, which increase, and the negative deposit rate, minus 0.4, create an environment where it is almost impossible for the European Central Bank to exit on its own. There is an exit, there's one exit, and that is that you have these structural reforms. Now let me continue, because otherwise I don't comply with time. Yes, I can do that in 1 minute, Mr. Chairman. This I will skip. Interest rates in the US. Here we have the interest rates in the US. Well, not surprising. The capital market rates are pretty high. But, for example, in Japan, they are dropped dramatically by this enormous amount of purchases of government bonds. And here we see the interest rates in the Eurozone. So the upper line is the capital market rates. But you see already that the capital market rates are dropping fast, and that the policy and money market rates are now in the zero domain or even negative domain. UK I will skip. And then we come to, and then that's my final graph, Mr. Chairman, so don't worry. This is a very interesting graph. These are the government bonds with negative yields. And what you see is a division between France, Germany, and Japan. So what we see not only negative reals of the real interest rates, which was since the crisis of 2008, since the Lehman moment, normal on average. No, we see also a drop in the negative domain. And then, what is then the conclusion? And maybe Bob Barrow can elaborate on that. But what is the conclusion? The conclusion is that we are conducting fiscal policy with monetary instruments. This is not within the mandate of the ECB, not at all. We don't speak about, price stability, not at all. Core inflation, by the way, in the Eurozone is 0.8, so that's not dramatic, there's no deflation. But what is remarkable in this sense is that the ECB is conducting fiscal policy without a mandate and without having a political union. So there is redistribution from the savers in the north, Netherlands, Finland, Germany, to the debtors in the south. So there is no neutrality of money at all, to put it in Hayek terms. We know that normally a central bank should be neutral over the cycle, not every moment of the cycle, but over the cycle. There is no neutrality. Japan is, of course, the most extreme case. I would say what the Fed is doing, that's very promising. I think it's very difficult because it's sailing between Scylla and Charybdis, what Janet Yellen and her colleagues are doing. For the ECB, it's now entering a new phase where I think that the exit is hard to find. Thank you very much.
Muchas gracias, profesor.